What's going on, ladies? Andrew Winnett here. Today we're going to talk about 3 things that you can do today to help protect your money from inflation. We're going to talk about what inflation is, then how it affects your money, and then we'll jump into those 3 things. What is inflation? Inflation, simply put, is where the cost of goods becomes more and more expensive over time. In other words, if you were to have a gallon of milk and it was $1 to purchase it at your local grocery store, and now it's $1.50, well, you have a 50% increase in goods, also known as a 50% increase in inflation on that gallon of milk. At the time of this recording, which is May of 2022, since the Biden administration has come into power, we have an 80% inflation rate on gas. So inflation absolutely affects you and me. Now, how does it affect your money? What does inflation do to your money? What I see oftentimes is I see clients who have lots of money in cash or in accounts that aren't earning very much. They may be earmarked for income, they may be earmarked for estate planning, they may be earmarked for growth, but they're not earning very much. If you've got money in a checking, savings, money market account and it's not growing, you're actually losing buying power. You're losing the value of that money. So for example, if you have $100,000 in the bank and right now inflation rate is about 8.5%, at least that's what they're telling us. You and I both know it's much higher, but let's just say it's at 8.5% inflation. If you have $100,000 and there's an 8.5% inflation rate, well, you're losing $8,500 in buying power from that money just sitting in the bank. Now, again, I know where people are coming from. They're concerned, well, what if that $100,000 was in the market and the market crashed, right? Then I could lose a lot more than 8.5%, and that is true. But that's the danger of inflation, is over time, it takes bigger and bigger chunks out of your money. So now we get into the meat and potatoes. What are the 3 things that you need to be aware of and that you need to take advantage of in order to help your money be protected from that lion of inflation that wants to consume and devour the purchasing power of your savings? Number 1 is you do not want to lose any money. So this may seem pretty simplistic and forward, but if you lose money, okay, so let's say, for example, you have $100,000 and you put your $100,000 in the market, and you do that because you need growth to help offset in this 8.5% inflation rate. Well, if you lose 10% in the market when you were trying to gain just to stay up with inflation, it's like a double whammy. You went like backwards, right? And so you're not taking a 10% hit, you're taking an 18.5% hit. And that's the thing, is we do not want to lose any money during this time. There are ways where you can safely gain growth and gain increase without the potential of losing it. So you have to ask yourself, am I in investments that are frankly a little dicey? Am I in investments where I might lose 20 or 30% if X, Y, and Z happens in the economy? You have to take inventory of that ahead of time. So number 1, the first thing you got to do is you got to not lose any more money. It's just like in a boat, right? If there's a leak in the boat, the first thing you got to do is you've got to basically stop the water from coming in if you're going to make it, right? Stop the water from coming in and don't make another leak in the process of trying to fix that first leak. Number 2, the second thing that you're going to want to do is you're going to want to get growth to offset the inflation rate. Now, here's the thing. Right now, inflation is 8.5% in May of 2022. It can be challenging to find something that is going to pay upwards of 8.5% where you don't lose money. And this is where there's a couple things that I am a big fan of that is worth mentioning. Number 1 is real estate. Real estate, especially in this day and age, an increasingly desirable asset class, especially in America at this time. There is so much more demand than supply that you could easily keep up with inflation at 8.5% through real estate. Now, of course, this can vary, based upon where you're living. If you're in downtown Detroit, or if you're in Compton or Stockton or whatever, maybe not so much. But where we're at here in the Nashville area, absolutely you can take advantage of that. That's a safe way for you to offset inflation. Some other ways where you can offset inflation is through different types of insurance products. Now, that could be a cash value life insurance, that could be a type of annuity, whether it's fixed index annuity, sometimes depending on how high interest rates go, multi-year guarantee annuities, those can also help offset inflation. The point is you've got to keep your ears and your eyes open, because there are some bad annuities, okay? There's some annuities that have high fees, you're not going to earn very much growth, and then there's some that don't pay very well. So you want to make sure you find the right ones. Having said that, though, it is a safe way for you to obtain growth. Sometimes in those cash value policies, through like an index universal life policy, you can actually earn 10 and 11% on average, even in an inflationary period like we're in. So there is that option. Oftentimes, index universal life outperforms whole life. If you look at the average over the market, again, you've got to know what you're looking for, but insurance and real estate is great ways to safely, obtain growth and never go backwards. The third thing that you can do today to protect yourself from inflation is you can be cashed up for the end of the inflation cycle. Now you're like, what the heck does that mean, cashed up? It means that you've got resources at the ready for when the inflation cycle ends. First of all, what is the inflation cycle? Well, this is how it goes. The first part of the inflation cycle is inflation's up, inflation's high. Well, the government and the Fed, what they do to offset a rising inflation is they raise interest rates. When interest rates go up, a couple things happen. Number one, the economy stagnates. And number two, unemployment goes up. So for example, interest rates often affect debt. It affects credit, it affects the housing market, it affects the operations of large companies. If you take a company like Walmart or Amazon, they use lots of debt to operate. So for example, let's just say the southeast region of Walmart, I don't know how many stores that is, it's a lot, but let's say they've got a $100 billion line of credit to help operate in those stores, okay? Because they're not like debt free, okay? All of them have debt to operate. So, $100 billion line of credit, the interest rates went up 2%, which means that line of credit is now 2% more expensive just to operate as before. They're losing $2 billion in profit margin just to operate like yesterday. Well, one of three things happen when a big company like that takes a $2 billion hit. Number one, the stock price goes down because the profit margins shrunk. So no one's happy about that, right? The second thing that happens is they have to raise prices, to offset their loss in profit. The third thing is that they will have to cut costs. And the biggest cost to a company is employees. So they cut costs to make up for that lost $2 billion. So the stocks are affected, the market's affected, the prices increase, and the unemployment numbers go up. And oftentimes this is where it starts big time. They will usually wait to raise prices, but boy, the people are the first things to go. So they will slim down, and that's why unemployment goes up. So inflation rate is high, that's the first step. The interest rate environment will go up to offset inflation, which stagnates the economy and raises unemployment. Then after an extended period of that time, then you can slip into a recession where the GDP stagnates so much, the gross domestic product of our nation stagnates so much that we begin to recede, or we go into a recession. And after that, that's where you want to have all the money. where you can buy distressed assets. You can buy real estate, you can buy commercial buildings, you can buy whatever for 40, 50, 60 cents on the dollar and set yourself up and your family up to never have to worry about inflation because you bought all these assets on the cheap. The question is will you be ready during that time? And that's why you can't lose money. You got to make sure your money's growing and you have enough cash on hand. Warren Buffett does the exact same thing. He has 25% of his money in cash waiting for the inflation cycle to get to the very, very end to where we're in a recession and he can just buy a bunch of stuff up. Well, once we hit a recession, then what the government does is they lower interest rates to stimulate the economy through cheap debt, easy credit, everyone's buying again, and that's what stimulates the economy, and round we go with the inflation cycle. So expect to see some stagnation over the upcoming years. We're not going to see this ridiculous amount of growth in the market like we've enjoyed since COVID. That was superficial, that was hot air, it was cotton candy, it was a bunch of sugar, it wasn't real. We are going to go into a season of stagnation as the Fed raises interest rates. Make sure you're prepared, make sure you're not going backwards with your money, make sure you're safely growing it and getting ready for when the recession happens. It will happen, it's just a matter of when, and when it does, more millionaires and billionaires are made in times of recession and depression than any other time in history. I want you to be one of them. If you like this video, please like and subscribe. I love giving this content out and I love equipping you in order for you to be able to make informed decisions for your hard-earned money so you can have the retirement of your dreams. I look forward to seeing you on the next video.